Hey everybody, happy Wednesday, happy FOMC Wednesday. Hope everyone's doing well. Welcome to Charts and Coffee. We've got Jerome Powell, Powell, as we like to call him in the Sector Secrets Mastery, up at 2 p.m. today and 2:30 for the presser. Well, 2:30, that's when he makes his big appearance. And we are, what is discounted, we are expecting a hold from the Federal Reserve today. And it's likely those FOMC members are going to largely vote to, you guessed it, hold and kick the can down to July. Now, if we're talking about July, that means the press conference is really not so much about why did you hold, Jerome, and where do you see the economy going? It's going to be the same line. However, between the rate statement and whatever changes, updates have been made, and whatever is said during the press conference, the expectations for whether we hike or hold in July, and therefore how we can go into pause precedes pivot, and when, if this year at all, we're going to see the first rate cut. That's where we sit. That's where all the fireworks are coming. And I'm bringing up the bond market first. And as always, gang, if you have any questions, feel free to type them in. Let me know what time frame. Let me know if you have a position or want to put on a position. The more detail, the better. Feel free to type them in. Phone lines are open for your requests. I would love to get long bonds. Yesterday in the free video, I posted a number of symbols that I'm interested in. I would love to get long bonds. Now, wanting to get long bonds, being bullish on bonds, which is to say bearish on yields, is one thing. Actually having a setup that's triggering where we can control risk and expect some decent follow through. I mean, that's really what a trade is, right? Not just an entry. It's, can I control risk from where I've entered? And can I anticipate at least a decent amount of follow through so I can have a decent return on my capital being tied up in a futures contract, in a stock, in an ETF, or an options contract, right? And that's where I'm waiting to see if we see an initial reaction of weakness from bonds, which is to say higher yields, as we may be expecting a hike in July. Lots of uncertainty, but this is where, as a trader, if we can think about the different scenarios and what different symbols will do in different scenarios, we can sort of imagine, okay, this is what a short setup would look like. This is what a long setup would look like. On the daily time frame of the S&P, it's long only. This has been an uptrend since the first week of June, and this is buy the dip. Same goes for the NAS. If there's going to be a short in these two indices specifically, it's likely going to be a 60-minute time frame or a 5-minute setup with the 2:30 press conference volatility, right? So already I know timing. I already know which symbols. I already know which direction. And that's where, if you can have in your mind those types of sequences, right? What are the sequences? What are the numbers, right? What price are we going to get involved in? And what are the criteria that need to be met before we do it? That's trading, right? And if those criteria are not met, if that number is not reached, nothing to do, okay? So as always, gang, thanks for being a part of the Caffeinate and Dominate crew. Let's go ahead and jump on into our questions. And here we go. Andy, good morning. All right. Andy asks, I missed the Sunday show. There wasn't one, Andy. I don't know if y'all knew. Friday, I lost the internet because it was physically cut. Everything's buried here. So an errant tree being planted could knock out the neighborhood. So you did not miss anything. It was no show. I was still getting my internet back. I was thinking about making it up at some point, but I've been playing a little bit of catch up here in the office. But thank you for asking. The show does start Sundays at 6 p.m. Eastern. You got it. You got it. And but by the way, if you need a little bit of a fix, Andy and anyone else, Countdown Trader, COUNTDOWN, Countdown Trader. Let's see here. I do have Trish posted a really cool update. And if you go to Countdown Trader, I'm going to go there right now, .com. I posted, it's been posted a couple skills. I'm really obsessed. Well, Trish has really been very much saying, Rog, let's talk about losing. Kind of a weird topic, right? Let's talk about losing and how being a good loser, skilled loser, is the path to being a profitable trader, right? They always say, take care of the downside and the upside will handle itself, right? And I think there's a lot of truth to that. So if you check out the update, talked a lot about how to be a good loser, and also what is it that would define a loss, and how do we manage a loss, and how do we manage a fixed percent account risk to our accounts so we don't let a series of bad trades annihilate our accounts. We can't come back and trade the next day. So anyways, thank you, Andy. I appreciate it. All right. John asks, who are my early trading mentors? Who are my early trading mentors? Probably super early on, although she wasn't an active trader. Probably my mom. She was the one that was sort of in my household. She was the first one to start doing some market timing and some active, I'd say some active investing or some position trading, if you will. But John, I really loved, and you got to remember, this was the late 80s, early 90s. So we didn't have, this was back still when we had Walden Books, right? Borders and Barnes and Noble and Amazon and whatever else, having access to all the websites and all the books. This was not the case back then. So my early mentors were people like Schabacher, Dow, their writings, right? Whatever I could get a hold of, Wyckoff, Darvis, right? And Darvis is really the most recent. He was in the 50s and 60s. Everyone else in the late 1800s or early 1900s. I love the old trading books. And when you read those old trading books, like Schabacher, for example, every single book on technical analysis that's been written since Schabacher is really a rewriting of that. And so I love finding the old books. That stuff was the most, especially Charles Dow, and was posthumously coined as Dow theory. That was especially, John, influential on the indicators that I've created and the trading style that I created for myself. Yeah, thanks for the question. Okay, next up is Mr. Walker. Hello, good morning. Top 3 sectors in the XLK. What are the top weighted sectors in the XLK? Sure. So if we head on over, let's pull up TradingView, shall we? Haven't been using TradingView a lot. Let's do that. So when I pull up, say, the NASDAQ futures, all right. When I pull up the NASDAQ futures, and I imagine this as a car, and I want to, see what's under the hood, in order of weighting, XLK, XLC, that's what you're missing from the list there, and XLY. Healthcare is not significantly weighted. It's on a top 3 in the NAS. So XLK, XLC, and XLY. Those are the 3 top weighted sectors. All right, Darren asked, any thoughts on SOFI? Moving up, obviously very swiftly. I'm sure it's on a lot of folks' radars. No, I don't have any thoughts on it. It's got to pull back before I can do anything with it. Darren, whenever I see a sub $10 stock, or frankly, even a sub $20 stock, I'm less interested in the price and I'm far more interested in the volume, which is to say, where is the participation in a very low cost stock? Anything that's gone parabolic, as SoFi has, obviously, now I shouldn't say obviously, any stock that's gone parabolic, as SoFi has, is going to have volume levels that acted as support and acted as resistance and were probably the foundation from which everything went higher. All right, so how does that work here in this stock? Take a look at the point of control for 2023, down at 572, 573. That's the most volume that's occurred in this stock all year. There's a lot of opinion there. There's a lot of money there, right? Okay, the next level that we can look at is just above it. Look at all the volume, though. You can see the histogram running vertically on the right side of my chart. So along the hard right edge, I've got price-based volume, right? If you want to know its size, institutions, banks, that big money we talk about, we look at volume based on price. The next ledge is sitting at about 670 and change. That's the next level at which was going to be resistance. And if we get above it, likely we'll see some stops being run. Look at the candle Look at the way the candles reacted. We gapped through the point of control. We had a huge candle going into that volume ledge. And that's what I'll look at on things like that, Darren. And that's going to be any stock, gang, that's under 20 or $10. All right. Thanks for the question. Robert says, I've seen several people do 0 days to expiration strangles just prior to these announcements when implied volatility starts to drop. It starts to actually increase depending on the event. Do I think this is a good idea or just a coin flip? So let's talk about, there's a lot to unpack there, Robert. So 0 days to expiration simply means the option expires today. I know you know that, Robert, but everyone else who's thinking, what's a 0 DTE? 0 days to expiration. SPY has 0 days to expiration. QQQ has 0 days to expiration. Of course, SPX does. I think the SPX, which has been around forever, has become the popular kid in class over the last year or so. So everyone's, if you want to grab people's attention, SPX and 0 DTE, right? That's a hot ticket. So the thing to remember about any kind of strategy, the way I think about it, Robert, is in and of itself, 0 days to expiration is really a play on time decay, right? So I think 0 days to expiration favors traders who can find the timing of collecting more premium when selling the option with a very short window before that option is worthless, right? There's that. There's also traders who like to buy the 0 days to expiration option because it's less expensive, because ultimately what you have is an option with very little time, and that component of premium is very, very low. But implied volatility is not necessarily going to drop just because of 0 days. So for example, depending upon the event, that option will be not expired, right? That'll still be active, not expired through. Sometimes implied volatility can be higher. Think earnings, think FOMC, that kind of thing. So it depends on the event that the option will still be open through, right? So the whole idea of writing options is that you can take advantage, to me, right? This is just my opinion, gang. The whole rationale behind writing an option is you feel the option is going to expire worthless or at least less valuable than what it was sold for. That's number one. And you can take advantage of higher implied volatility, which is one of the key components to collecting more for the option. So in terms of a strangle where you're going to hold both the put and the call option at different strike prices, that's all then the nuance around how you want to position based on volatility or the trend or how you want to position yourself in such a way that, look, you may not want one of the sides of the strangle to be touched, right? I mean, if you think about the strategy around it. The best way I think about multi-leg strategies, and this is an aside to everybody, is I think about multi-leg strategies where you have 2 legs, 3 legs, 4 legs to an option, is what is the job of each leg of the option? Do I want it to expire worthless? Am I wanting it to increase in value? How am I paying myself on that option? Is it about collecting credit, or is it about paying a debit and expecting that value to go up? So when I break it down like that, I think less in multi-leg option strategies, and I think more in what is the job of each individual piece. And of course, a strangle would be no different. All right, next up is, thanks for the answer, Barry. Again, yes, the top 3 weighted sectors in the NASDAQ are tech, communications, and consumer discretionary. All right, next up is Sergio asks, is there any specific reason I use the 34 EMA instead of the 21? So Sergio, the Fibonacci number sequence, which starts far smaller. A lot of traders will use numbers like 5, 8, 13, 21, 34, 55, 89, 144. And back in the late 90s, mid 90s, I got really curious and tested the Fibonacci series on the high, the close, and the low up to 1597, which, yes, happens to be a Fibonacci number. And the reason I used the 34 is when I was doing all that testing way back when, over 2 decades ago, I found that the 34 acted as the backbone of a trend, and therefore also my preference for a mean reversion. 21s are great. I use a 21 propulsion, so it is represented on my chart. But for me, when I'm looking for mean reversion, and gang, remember, there's no official mean reversion. It's simply based on what different traders feel is their level from which they feel a retracement has reverted to the mean. There's mean reversions of a VWAP, there's mean reversions on a moving average, etc. And I found that 34 worked best for me. And then it also is the reason for my color-coded candles, which I call the grab candle. So testing, what's the specific reason? Lots and lots of testing. And not just the 34 and 21. I tested the 13, the 8, the 5, the 89, the 55, the 1. Like I said, I tested the whole series up to 1597. All right, next up, TLT for a swing after 2:30. I am bullish TLT. Yeah, I am bullish TLT. Raphael Lemboy, I am bullish ZB. Yeah, same thing, different flavor or different, choose your own adventure. I am bullish, but kind of going back to, is price action reaching, is it fulfilling the sequence that is required for me to have a valid setup? And then additionally, is it in the price zone from which I can manage risk? I would love to be long, especially bonds. Ultimately, when it comes to bonds, I find that bonds like the front run Federal Reserve action by 6 months, give or take a couple months. It's on a fixed 6-month thing, but right now bond traders are not thinking about today or frankly, even July. They're wondering, does the Fed hike us into recession? Does the recession then cause the Fed to cut rates? Or let's say we don't get hiked into a recession. Let's say the Federal Reserve simply decides to pivot later this year. Bonds in many ways are discounting that narrative. They're way out in the future. Not to mention, we're trading the September contract for bonds, right? So when we have contracts with futures, that's the quote unquote delivery month. That's the month at which we're trying to speculate what our rate's going to be come that delivery month, come that contract month. And ultimately, if I think about that, 6 months from now, do I anticipate that we will be expecting lower yields? Will we have been in a pause at that point? And I think bonds are saying, and I'm seeing, yes. So I'd like to get long bonds, which is a way to take advantage of the eventual lower yields that we're going to see. All right, Dimitri asks, can I please give more details as to why I don't use a hard stop? Okay, so number one, gang, I have the benefit, right? I have the privilege of being able to sit here in front of my desk and trade, right? So I have access to the market. This is what I do. So I don't have to necessarily walk away. I'm not trying to do 9 things in a day. Like so many people are trying to trade and they have a job. I get it. Or they trade, they have kids. Some people say, hey, I'm taking care of my parents. A lot of people have different things that are going to distract them from the market. And for that situation, I would not recommend necessarily having a stop in the market that is not placed. So a hard stop means an order, it has been placed and it's active in the market. I know where my stops are. They're based upon points of validity. They're based upon account percentage risk. They're based upon premium risk of the option, etc. But no, I don't place a physical stop. I'll place alerts, but I don't place a physical stop. And why? 2 reasons. One, well, the first reason is I've been doing this for 30 plus years and I'm pretty comfortable with a certain amount of risk. And frankly, my account size is that where I can absorb the occasional much higher than expected stop. Okay. That aside, those are personal reasons. That aside is I don't like to have a physical stop out there because while stop running is not insidious, it is real, right? The market moves in the direction of the most stops, and the market's job is not to take out our stop. It's just to fill orders. And if our stop is in a group where orders are going to be filled, we're going to be hit. So I want to make, for me, kind of like a quarterback, they get up to the line and they're looking at what the defense is doing, and they can make a decision at that point in time based on experience and what they want to do. And that's kind of the way I look at it, right? But I do have alerts. I'm not unaware of what's happening. And most of the time, I'm right here and I have that benefit. So that's why I typically have the luxury of doing that. All right. Next up is, how can I get those white dots on TradingView? Go into TradingView, click on indicators and search Simpler. And it's called Simpler Propulsion right there. It's one of the many indicators that I've made available free. You'll see Darvis boxes there. We have grab candles. We have propulsion. And what else have I made free? And Darvis. Oh, and the automated support and resistance of Darvis, a Darvis 2.0. All right, gang. So thank you as always. Thank you as always for being a part of Charts and Coffee. I will see you all tomorrow, same time, same station. FOMC 2 p.m. Eastern, gang, but the big thing is 2:30 press conference. I will see you tomorrow. Be good to each other.